Welcome back to the deep dive. Today, we're drilling down into the financial bedrock of major corporations. We're talking about their massive holdings.
The really big assets, right? The buildings, the machinery, all the long-term tech.
Exactly. And we're asking a pretty simple question. What happens when the value of those things, a value they spent billions to book, just disappears?
Well, it's really the difference between a planned expense and an unexpected catastrophe.
Explain that.
Every company plans for depreciation. The normal, predictable decline in an asset's value over its useful life. That's just business as usual.
But that's not what we're talking about today.
Not at all. We're talking about something sudden, a huge technological shift, a new regulation, maybe even physical damage that means an asset is suddenly worth a fraction of its book value, almost overnight.
And that sudden required acknowledgement of a major financial hit is what we call asset impairment. Our mission today is to crack open International Accounting Standard 36, or IAS 36.
Right.
We really need to get to the bottom of the difference between routine wear and tear and a forced write-down. What signals demand this kind of action, and why is the math involved so intentionally complex?
Precisely. And we have to start with that core distinction. Depreciation under IAS 16 it's systematic, it's planned, it's gradual, it's just an allocation of cost.
Okay.
Impairment is the absolute opposite. It's sudden, it's a non-negotiable loss, and, this is key, it's not recorded until specific triggers force management's hand.
So let's start with the easy one. Depreciation is, like you said, just standard procedure.
It's scheduled consumption. You buy a $5 million machine, you expect it to last 10 years, you book $500,000 in depreciation expense every single year. Simple.
But impairment, that's the alarm bell going off.
It is. The rule of thumb is conceptually simple. Impairment has to be recognized whenever an asset's carrying amount is greater than its recoverable amount.
So the moment what's on the books is more than what it's actually worth.
That's it. The moment you realize that, a loss has to be booked.
But you don't just wake up one day and decide to do it. You have to wait for those triggers you mentioned, these impairment indicators.
Exactly. And we can sort of split them into two buckets. Internal things from inside the company and external things from the market.
Okay.
To make this real, let's imagine a company. We'll call it Future Tech. And Future Tech owns a massive, specialized factory, let's call it the Titan plant, that makes a certain kind of legacy computer chip.
Got it. So starting inside the Titan plant, what are the internal flags that would force an impairment test?
Well, the most obvious one is physical damage. A fire, a flood, something that breaks the machinery.
Sure.
But it's often more subtle than that. It could be a major change in how the asset is used. For instance, maybe management cuts production at the Titan plant from 3 shifts a day down to just 1 because demand has cratered.
Or it could be a strategic decision, right?
Yeah.
If they suddenly announce plans to sell the plant in the next year or two when they originally planned to use it for another decade.
That's a huge one. That accelerated timeline is a massive signal. And finally, just poor performance. If the plant consistently fails to meet its profit targets, that's an internal red flag.
Okay, so that's the view from inside. What about the external shocks, the things that come from outside the business?
These are the big ones that can hit an entire industry. For our Titan plant, the biggest threat is definitely technology. A new, much better chip standard gets developed.
And suddenly the Titan plant's equipment is obsolete.
Instantly obsolete. Or think about the macro environment. New environmental laws might restrict the plant's operations. Or a big economic downturn.
What about interest rates?
A sharp rise in market interest rates is a huge external factor. It changes the whole valuation of the future cash flows you expect from that plant.
Now, there's a really interesting one you mentioned that connects the company's books directly to the stock market.
Ah, yes. This is a critical one. An external indicator is triggered when the total carrying value of the company's net assets.
So everything on their balance sheet?
Right, when that number is greater than the company's market capitalization.
Which is the share price times the number of shares.
Exactly.
Wait, hold on. So if Future Tech's books say it's worth $20 billion, but the stock market values the entire company at only $15 billion.
The market is shouting, "We don't believe your asset values are real."
Wow.
It's the market's judgment overriding management's. It's basically signaling that there's a $5 billion impairment waiting to happen, and it forces them to run the test.
That is a powerful external check.
Yes.
Okay, so an indicator internal or external has been triggered. Now the accountants have to step in and calculate the recoverable amount.
Yes. And remember, we only book a loss if the carrying value is greater than this recoverable amount.
So defining that number is
Yeah.
Everything.
It's the core of IAS 36. It represents the maximum economic benefit you can realistically get from the asset, and it's defined as the higher of two calculated figures.
First up is the simple one. What can you sell it for right now?
That's its fair value less the costs of disposal, the net cash you'd walk away with if you sold it today.
And the second figure.
The second is more speculative, and it's often the most critical part of the calculation. The asset's value in use, or VIU.
And you have to take the higher of the two.
Of course. No rational person would sell something for less than they could earn by using it.
A quick note on that fair value. If FutureTech has already signed a deal to sell the Titan plant, we just use that price, right?
You use that price, and if it's an asset that you can't even sell, like a highly specialized internal database, then fair value is effectively zero, and the whole test just comes down to its value in use.
Okay, so let's dig into value in use. This is where it gets complicated.
It is. VIU is the present value of all the future cash flows you expect to get from continuing to operate the asset, plus what you'll get when you eventually sell it.
So we're forecasting the future and then discounting it back to today's money.
We are, and IAS 36 puts really strict guardrails on those projections to stop companies from being overly optimistic.
You can't just project infinite growth and avoid the loss.
Exactly right. Generally, when you calculate VIU, you're restricted to using cash flows from only the next 5 years.
Only 5 years.
You can go longer, but you need a very, very strong justification. And beyond that 5-year window, you have to apply a decreasing or even zero growth rate. It forces a very skeptical view.
And what's interesting is what you're forced to leave out of the calculation. You have to ignore future capital spending and any revenue that comes from it.
You do. You also have to ignore interest payments and tax-related cash flows.
Why are those rules so strict?
It's all about isolating the power of the asset as it stands today. If FutureTech needs to build a new wing on the Titan plant to make more money, that's a new investment decision. It's not part of the existing asset's value.
I see. And excluding interest and tax helps measure the asset's raw operational performance separate from how the company is financed or where it's located.
Exactly. You're trying to find the pure, unadulterated economic benefit of that asset. Then you apply a discount rate to bring it all back to today.
And that discount rate is everything. A higher rate means future cash is worth less today, making an impairment much more likely.
It is. And that rate has to reflect risks specific to the Titan plant itself. It could be a project-specific rate, a market rate, or the company's own weighted average cost of capital. It's WACC.
Okay, this brings up a really important distinction. Revaluation. We know companies can sometimes increase an asset's value under other standards. How is that different from this mandatory impairment test?
This is critical. Revaluation is an accounting policy choice. A company can choose to do it, and it can result in a gain or a loss. If a building's market value drops, that's considered an assumed loss.
Assumed because they haven't actually sold it.
Correct. Impairment, on the other hand, is not a choice. It's a mandatory requirement, and it only ever results in a decrease. It reflects a genuine, often permanent loss in economic value. It's treated as a real loss.
So even if a company uses the simple cost model for all its assets and never revalues anything up, it still has to do these impairment tests.
Nobody gets to opt out of recognizing a real failure.
Okay, let's throw a wrench in the works. Back to our Titan plant. The boiler room in the factory doesn't generate cash on its own.
Right.
Neither does the security system. They're essential, but they only work as part of the whole. So how on earth do you test them for impairment?
And that is the entire purpose of the cash generating unit, or CGU.
Good.
The standard defines a CGU as the smallest identifiable group of assets that generates cash inflows that are largely independent of other assets.
So you basically keep grouping things together until you find the smallest unit that makes money on its own.
That's the idea. So for the Titan plant, the CGU is probably the entire factory. The boiler and the production line only create value together. A CGU could be a bank branch or a single delivery fleet.
Or in this case, the entire factory.
The entire factory.
Yeah.
And if we find that the recoverable amount of that entire CGU is less than its combined carrying value on the books, we have an impairment loss.
And you have to allocate that loss across all the assets in the unit.
Yes, and there is a very strict mandatory order for doing it.
A waterfall, basically. What's the order?
First, you'd write down any specific asset that was obviously impaired on its own, like a machine damaged in a small fire. But the second and most important step is this. You must fully write off any goodwill associated with that CGU.
Ouch. So goodwill is the first thing to go.
Completely. When FutureTech bought that plant, they probably paid a premium over the physical asset value. That premium is goodwill.
The value of synergy, brand reputation.
All of that. And the standard sees it as the most speculative, non-physical asset. So if the unit is failing, that subjective goodwill has to be the first thing to disappear.
That makes a kind of brutal sense. The premium you paid for future success is the first thing you lose when that success doesn't happen.
It is, and if there's any loss left after goodwill is gone, you allocate it across the other long-term assets on a pro rata basis.
But not to cash or current assets.
Never. Those are excluded.
Okay, before we leave the calculations, what about assets that have to be tested every single year no matter what, even with no indicators?
There's a mandatory list. 3 critical items. First, purchased goodwill has to be tested annually.
Got it.
Second, intangible assets with an indefinite useful life. Think of a major brand name that doesn't amortize.
Okay.
And third, intangible assets that are not yet available for use, like a new technology still in R&D. If it's not generating cash yet, its value is highly uncertain and needs annual scrutiny.
Right. Now, what about recovery? Let's say the market shifts again, and the Titan plant's old chips suddenly become super valuable. Can Future Tech reverse that impairment loss they booked?
Sometimes, but the rules are extremely cautious. The number one non-negotiable rule is that an impairment of goodwill can never be reversed.
Never. Why so harsh?
Once it's written off, it's gone for good. The standard basically says the original write-off proved your initial expectations were flawed, and you don't get to just reimagine that subjective value later on.
So that loss is permanent. What about for the other tangible assets, like the machinery?
For those, a reversal is allowed, but only up to a very specific limit.
And that limit is the asset's original carrying value, right?
It's the value it would have had today if the impairment had never happened in the first place, taking into account the normal depreciation that would have occurred.
So you can only recover up to the point of its historical cost and scheduled wear. You can't use a reversal to artificially inflate the balance sheet.
Precisely. The system is designed to prevent that.
We should also quickly clarify what this standard IAS 6 does not cover.
Right. It's important to know the boundaries. It excludes things like inventories, deferred tax assets, and financial instruments. They all have their own specific impairment rules under other standards.
It also excludes assets that are already being measured at fair value all the time, with changes going through the income statement, things like investment properties or biological assets.
If the value is constantly being marked to market anyway, you don't need a separate impairment test.
And finally, disclosure. You have to tell the world about this.
You do. It's mandatory. You have to disclose the reasons for the loss, the exact amount, and which assets or CGUs were affected, all in the notes to the financial statements.
Which brings us back to that peer pressure rule we talked about.
Yes. If all of Future Tech's competitors are recognizing impairments because of this new technology, and Future Tech is the only one that isn't,
They have to explain themselves.
they are required to disclose why they haven't recognized a loss. It forces them to justify why their assets are somehow immune to an industry-wide problem. It's an invaluable piece of information for anyone reading those footnotes.
So what's the big picture here for us? We've seen that depreciation is the planned, systematic cost of using things up. Impairment is the sudden, required recognition of a real financial failure.
And the whole process is designed to find a true value, forcing management to choose between what the market will pay today and a very conservative, highly controlled estimate of future cash flows.
At the end of the day, IAS 36 really shows you the deep skepticism baked into financial accounting.
It really does. Recognizing a gain through revaluation, that's an optional policy choice. But recognizing a loss through impairment, that is a non-negotiable requirement.
The system demands you be brutally honest about failure.
Exactly. It forces transparency when things go wrong, but it remains incredibly skeptical and restrictive about allowing you to claim that you've recovered. Recognizing a real loss is mandatory, but proving you fully regain that value is a much, much higher bar to clear.
And that's our deep dive into IAS 36. Thank you for joining us.